Hi, thank you for joining us for today's webinar. My name is Dave Mantell. I'll be your presenter today. So, for today's topic, we're going to be covering how to retire at age 55 from Microsoft. I know that's a topic on many of your minds currently. And so, through the presentation, we'll get into the nuts and bolts on steps to be doing now to prepare yourself for such an age 55 retirement and how to make that transition smoothly. I should note that it doesn't need to be strictly retirement for this webinar to be the right webinar for you. You may be thinking of it as semi-retirement or a career change. But in general, if you're planning on making a potential shift at age 55 from Microsoft, either fully retiring or something more custom in nature, we'll still hit on many important topics that will apply to you. Let me share my screen here and we will jump into things. So, how to retire at age 55 from Microsoft. Before we jump into the presentation, a couple little bullets about us. So, at Stabler Wealth Management, we're fiduciary financial planners. We specialize in working with Microsoft professionals, both in preparation for in that transition to retirement, work optionality, financial independence. We have a team of certified financial planners, CFPs, as noted, that making us a fiduciary. And our real focus is providing personalized advice and care to our clients to help you drive those best outcomes. And so that goes beyond investment management. That's financial planning, retirement income planning, tax strategies, estate planning, how that works into your estate. And so anything finance related, we look to be involved with and assist where we can. And so as we do articles, provide information to Microsoft professionals as well as others, we'll have all that information on our website at www.stablerwealthmanagement.com. So that's a great resource. If you go to the Insights page, we've done a bunch of great Microsoft materials. So definitely worth checking out and scanning through there. And you might see a topic that piques your interest. Okay, with that, on to the presentation. So today we're going to cover a number of different aspects that tie to that age 55 retirement. First off, we'll hit on why is 55 a magic number. I think many of you may have an idea of why, but we'll provide a little bit more thought on that. How to get ready for retirement. So we call them the ramp up years, those years ahead of age 55. You could really cover a lot of ground and change your retirement complexion. And health insurance, right? That is the biggie that is on most of your minds. And we have some big changes to the tax and health insurance laws coming up next year. So we'll cover that and what that means to you and how to prepare. Social Security is a key component, even though that doesn't kick in at age 55. It does play into your age 55 retirement plan. And then probably most of you listening in have a good amount of Microsoft stock. That's not a bad thing. It's actually been a wonderful thing as the company stock's done so well for the past decade plus. But also just want to shed a little bit of a light on how that could be a risk and what to do about it without getting hammered in taxes. So we'll go over that a bit there too. And then I'll close it out with a couple overall thoughts there. That all sounds good. Okay, good. So again, the title of the webinar, Retiring from Microsoft at age 55. That begs the question, why 55? As most of you are likely aware, once you're 55, if you've been at Microsoft for 15 consecutive years as a full-time employee, when you separate at that point, the year you turn 55, by the way, not your birthday, your RSUs that have been earned but haven't been vested yet, so unvested RSU stock awards, will continue to vest after leaving. That is a nice, sizable chunk of runway in those early retirement years where you'll continue to have that stock vest, which really acts as another income stream for those, several years ongoing. Because of course, as you receive your stock awards, those vest over multiple years. And hitting that 55 and 15 point allows those to not just go away, go bye-bye, right? You're able to continue to receive those on that continued vest date. And so, yeah, it's a little bit different than like if you have paid time off you haven't used. I know there's been all these layoffs, right? That's on everyone's mind right now. The severance comes in like one big check if that applies to you. The 55 and 15 will continue to vest on the same schedule, but that's kind of nice where the taxes are spread out that way, and it can really act as sort of a retirement income buffer. So that's the bulk of why that age 55 matters, right? I'm sure many of you are nodding your head there. With that, there's another key component at age 55 that's also very applicable. And what that is that you are able to access your 401k the year you turn 55 without that 10% penalty if you're separating from your employer and you're not getting another job elsewhere, right? So this is kind of your most recent employer. And that's pretty meaningful. Typically, you can't tap your 401k until you're age 59 and a half without penalty. Same thing with a traditional IRA retirement account. And so by separating the year you turn 55, again, the year you turn 55, not your 55th birthday. Same thing with the 55 and 15 rule. You can access your 401k without penalty. So again, another nice liquidity bucket you can access because liquidity is very key, right? When you're taking money out of your accounts versus saving. And so again, another nice factor of a 55 age. You'll still pay tax when you take money out of your 401k, right? But it's sure nice avoiding that 10% penalty swing. So basically what that does is by having your unvested stock continue to vest, you have another liquidity point you could access with your 401k without penalty. It really opens the door to be able to reach those different income streams. You can imagine without that ability to reach your 401k, certain companies have a different, dynamic. But if somebody had a lot in their 401k, they'd be like, "Oh, I'm kind of stuck. How can I access this?" And so that's really a nice feature with that age 55 retirement. Okay, good. With that being said, if you're 54 and you're about to retire or you get laid off, again, there's different routes we can take and things to look at. But that stock vesting schedule alone is a biggie. If you haven't been at Microsoft 15 years, that wouldn't apply, of course. Okay, good. Okay, so now that we've established why age 55 is that magic number for retirement or work optionality from Microsoft, the next step is as we approach age 55, as I coin the ramp up years, these are really critical years where you can move the needle a ton on your retirement readiness. And there's a few different reasons for that. One of which is typically, later in your career, these are your higher earning years. You have good cash flow that gives you flexibility to maximize all the various benefits that are available. And so, for example, by maxing out your 401k, your health savings account, if you're on the health savings plan, your mega backdoor Roth, regular backdoor Roth, ESPP, right? There's a bunch of different features. These are all different tools where when you total it all up, you could save $100,000 a year in either a tax advantage or a discounted way with the ESPP. And so that starts adding up pretty nice, right? If you lace a few of those years together, you could really supercharge your savings in those final years. And so that's one item, those higher earning years that gives you more cash flow flexibility to do so. I should note, even if you say, I don't have 100 grand laying around of extra cash flow to fund all these things, you're still, there's different avenues to do that. For example, you could use non-retirement accounts, brokerage, vested stock to basically take some of those funds, help fill up those tax advantage buckets. And that will basically give you a way to channel or funnel funds from a non-tax advantage bucket to a tax advantage bucket. And that could have a lot of leverage on your savings, right? When you think of all the tax or discount benefits when it comes to the ESPP there. But again, those last few years before retirement, if you're able to slug 100 grand between what you and Microsoft puts into these, highly tax leveraged accounts in terms of, saving money on that versus a normal account, that could really build up your savings quickly. Um, Other facets of a ramp up years. So with that, you tend to also accrue a lot of RSUs, a lot of stock awards with all your time at Microsoft. If I could have you remember a couple things from this presentation, I know we've hit on it in a lot of articles, is I would think of RSUs, so stock vests, as cash bonuses. And what I mean by that is that when your stock vests every quarter, February, May, August, November, you pay ordinary income tax on the entire vest amount. And that's whether you keep it in Microsoft stock, you sell it, whatever you may do with it. And so, what that looks like is if you're already paying tax on that, if you keep it in Microsoft stock, you're kind of making the decision to reinvest that cash bonus, I call it, into Microsoft stock. That's worked out really well the last decade, but it's really important to have good balance and diversity across your investments as you head into work optionality. And so, not necessarily the best move where you have extra cash to be adding it to your Microsoft stockpile already, given you have a lot there. And so, again, if I had one or two takeaways, one of them would be treat your RSUs as cash bonuses when they vest. And that could be used to supersize those other savings buckets that I just noted, where you are getting a tax benefit and diversification. And so, again, that ties right to that first bullet. Okay. So with the ramp up years, I like to say that retirement planning or retirement income planning doesn't just start when you retire, it starts in the years prior. And what I mean by that is you want to start building out the composition of your accounts, how your money's invested, how you're going to access liquidity and funds. You want to start blueprinting that beforehand versus, hey, I just retired. What do I do now? And so this slide's called ramp up years. The next bullet here, planning Roth conversions and managing tax brackets. That speaks a little bit to the gap years that we'll kind of speak to more on the next page. But basically, in those early years of retirement, you don't have your salary, your bonus. You don't have new stock awards. You'll still have the ones that are kind of rolling off if you hit that 55 and 15 number. But essentially, your income tax should be a lot lower than it was when you're working. And so that could be a really opportune time to move money from your 401k or IRA pre-tax to a Roth, where you pay the tax when you convert the money. But once it's in the Roth, you never pay tax on that amount or the growth if handled correctly. And what that permits you to do is basically shield money from taxes at a favorable bird in hand tax rate, 22%, 24%, sometimes even lower, depending on your different income streams. And that will set you up for really good tax flexibility down the road. And so, generally while you're working, you likely wouldn't do Roth conversions because, most Microsoft professionals that are in their, 50s, late 40s are in those higher tax brackets. But the early retirement years, you want to have a game plan and hit the ground running. And that is a really strong move to consider. Okay. And then, yeah, and so just to kind of piggyback on the prior three bullets, what this all does is it allows you to build flexibility to have good, flexible income in retirement that's available, liquid, low on taxes. You're not stressing out if the market's down. You have a good kind of mechanism and diversity in your investment balances. And this is especially helpful as we look at things. My next slide actually on how to handle health insurance in retirement is doing all these steps in the ramp up years lays the foundation to having a smooth transition to retirement in the early retirement and long retirement years for that matter. Okay. So good. So yeah, this is a lot of what we should be focusing on now in the months and years ahead of pulling the trigger. Okay. Great. Bridging for health insurance. So while you're working, you're on your employer's health insurance, which is great, right? It's largely paid for by Microsoft. It's subsidized. It's good insurance. When you retire from Microsoft, you're walking the plank and you're on your own a bit. And so there's some key ages and dates to be thinking about here. So the first one is that Medicare, doesn't kick in till age 65. And again, what Medicare is, we all pay Medicare tax. It's kind of, our country's health insurance program for retirees, seniors. And so once you're 65, health insurance is really good and very affordable. So the trick is getting to age 65. And if you're retiring at 55, 10 years is a pretty long range, right, to get there. So it's really important to have a good, sound game plan on how to do that. Okay, so here's the playbook. So first off, once you retire from Microsoft, you can be on COBRA for 18 months, a year and a half. And what COBRA means is that you stay on Microsoft's health insurance. You're getting their subsidized rate, but you're paying out of pocket. So I shouldn't say subsidized rate. You're getting the negotiated rate from Microsoft, but Microsoft's not subsidizing for you. They're not paying your insurance. You're paying out of pocket. And so overall, it costs a lot more than you're paying now when you're working, but it could be a lot. It's reasonable. It's quite a bit less than the other options. Your family can be on the COBRA too, right? So your spouse, you have children 26 and under that are eligible. So same thing. It's a continuation of your same health insurance, but you're paying the full freight yourself. Once we move from COBRA, uh, generally, I'll skip to the next bullet. If your spouse is still working, you'll probably get on their insurance. You may not even do COBRA, right? You'll probably flip on their insurance, and then when they retire, if they're eligible, do COBRA at that point. It's something you really want to look at and understand the details on. If your spouse is no longer working, then what you're going to do is do the ACA Affordable Care Act Marketplace. This is Obamacare that went into place, a decade plus ago. But basically what it is each state has its own exchange, or it might be tied to the federal exchange. So Washington, it's called Washington Health Plan Finder. You have a lot of the big players on there, the big health insurance names, Regents, etc. And you'll find a health insurance plan that fits you. The way it works now is that everybody gets a subsidy. And with the full subsidy from the government, it's really cheap, right? It's cheap insurance. The problem is, as your tax return income goes up, the subsidy falls off, it wears off. And so if you have $0 of income in retirement, that's actually, you don't want that because you might get forced onto Apple plan, which is Medicaid. Let's just say you have, 60, 70, $80,000 of income on your tax return in early retirement. Your health insurance is going to be really, really cheap. If you have $100,000 to $120,000, it's going to be reasonable if your income is in that 100 to 120,000 range, maybe even a bit more. Might be a bit more than Medicare, but not too bad. If you're showing 200, 250,000 plus of income on your tax return, you're going to get hammered with Medicare premiums. It's going to be insanely expensive. And so it's really important. You want your whole financial plan to tie not just into investments, not just into taxes, but health insurance premiums too, which count as another tax. And so a common one is in the ramp up years before retirement. We're going to want to see what we can to change the complexion of your accounts, make sure we have a good amount of liquidity available in places where you won't get hammered from taxes. Once you retire, if you go into COBRA, those next 18 months, same thing, you're going to be in a lower tax rate than when you're working, but we probably at least want to fill up the favorable tax brackets with capital gains. You might do Roth conversions and basically build up funds that are liquid and accessible that you can tap without a ton of taxes. And then what that allows is once you switch over to the ACA marketplace, let's just call it age 57 to 65, we'll kind of establish a runway and a game plan where we'll manage your tax return income. Because remember, when you pull money out of a bank account, that's not taxable. If you sell a bond, that's typically not taxable either, assuming there's not a big gain on it. The income from a bond is taxable, but accessing a bond isn't. You pull money from your IRA or 401k, that's all taxed as ordinary income, right? And so those first couple gap years of retirement, that's a great time to be showing capital gains at a low tax rate, moving things around. So we could set up a runway for how to keep your tax return income and health insurance income affordable. Okay. Yeah, that basically will get you to age 65 Medicare. Yeah, it's a little bit of a tricky one to kind of get your head around. Another wrinkle to this. So during COVID, they changed the rules on how that subsidy for the ACA marketplace, the Affordable Care Act, marketplace works. And it used to be a cliff where if your income was over, let's call it $80,000 today on your tax return, you're paying full freight, no subsidy. If your income's under 80,000, you get a nice subsidy and it's pretty cheap. During COVID, they changed it to a sliding scale where basically as your income goes up, as I was noting, the subsidy rolls off, kind of like it acts, kind of rolls off 8% for every dollar of income, 8 cents on the dollar. And so what's happened is that made it where there wasn't a complete line in the sand, where commonly for clients, we'd say, hey, let's fill up the lowest tax rates during these years where you pay 0% capital gains tax or 12% ordinary income on 401k IRA withdrawals. Right now, the rules are set up. We're starting in January of next year. We're supposed to go back to the cliff, where if you go a dollar over that threshold, I think it's 85,000 is what it's shaping up to be. Your health insurance premiums could go up for like a couple 20 grand a year or something like that, right? So you do the math over, 8 years or so, that's pretty painful. And so we are watching very closely to see if they extend the current sliding scale. I hope they do. It hasn't happened yet. And so it's really important to kind of stay up with all this. Because again, this could be several $100,000 of savings or additional costs if played incorrectly. And so I just threw the kitchen sink at you on this one. But again, it's really important. Your health insurance and retirement talks to your tax return, which talks to your investment planning. So it all needs to work in cohesion. Lastly, you want to make sure you get really good insurance for you, especially commonly those early retirement years. It's like, hey, game on, let's start doing some travel, right? And so you want to make sure you have a health insurance plan, and that could be done through COBRA, through the ACA marketplace, through Medicare, that matches your situation and needs. And so that's the other thing. It's really critical to get the right health insurance coverage for you. And so again, all things that we're happy to weigh in on and walk through and draft a game plan for. But again, this is a really critical one. And if done the right way, can turn out just fine and very supportive. But if you face plan into this, it could really be a setback to your retirement. Okay, good. Okay. So now that we've gone over the ramp up years, the gap years, early retirement, health insurance strategies, the next thing is part of, I alluded to earlier, retirement planning, retirement income planning does not start when you retire, it starts beforehand. And so really anybody within a few years of retirement, really, I'd say if you're like in your 50s, let's do it. It's a great time to design a cash flow plan. And so, the way I think about it is whether you are a Fortune 100 company, whether you're, AI founder billionaire, whether you're a Microsoft professional, you should be having a cash flow plan. And I know a lot of times people hear the word budget and they're like, oh, I don't want to do a budget. I don't need to do that anymore. It's being intentional about your cash flow planning. It's knowing how much you need, where dollars go, because that really ties into all these big financial decisions that you're making. And so the first step of that is creating a retirement paycheck in retirement. And so what that means is when you retire, the last thing you want to be doing is like not knowing how much can I spend, where do I take money from, what's that look like? And so designing a cash flow plan means that we're going to want to establish how much you need in retirement and send you a monthly paycheck from your investment accounts, the same way a current paycheck works, which is tax efficient and covers your monthly needs. And part of that too is we'll want to identify other expenses. I'm jumping ahead of my bullets here. But you want to know how much you can spend, how you're going to get that income, and how it's done tax efficiently. You do not want to be winging it. And so really the way to think about this is starts with that cash flow plan. What are your expenses? And what's that look like? I will note that your expense and lifestyle profile is going to change throughout retirement. I know it's the slogan you've probably seen before, but I like it. The early retirement years are go-go years. You want to do a bunch of stuff. You got time, energy, money, the desire. So you want to travel, do different things, get the camper, whatever it may be. So those are the go-go years. You're probably going to spend more money. Then you go into that period, might be like your 80s or something. For some people, your 70s. For some people, your 90s. The slow-go years where, you're just kind of a bit more of a homebody, right? You like your routine. Been there, done that on a lot of the travel. And so you're probably not spending as much money as you were earlier, and you don't have the crazy health insurance costs either, right? And then, in the later years, the no-go years, you're not doing a whole lot. I know it's not as fun to think about, but that's when there's worry about like long-term care costs and the expenses can go up. And so it's really good to model what are your expenses going to be. And I'd start with the go-go years, especially. And the best way I found to do this is see what you're spending now, look at your last few credit card payments to see what your bills have been, what your spending has been. Tack onto that any big goals, travel, things like that. And then you could kind of establish an idea of what you want your spend to be each year. Okay. Um, From that, yeah, do you think it's really important to include one-time expenses? Some we see a lot, kitchen remodel. We want to help our kids or, get them through college and, launching their careers, and it's so expensive to buy a home here. We want to help with the down payment and pitch in 100 grand or, you name it. But it's good to have an idea of what those one-off big expenses are on top of a normal monthly expenses. So that's really key. And I'll also note inflation could be really sneaky. We always want to plan for inflation, and especially healthcare inflation. It's gone up at a much quicker rate. And so in that case, using a lot of your tools in the right way, like a health savings account, can be really key here. And so, yeah, so once you kind of determine, hey, here's what I need for cash flow each month for a regular basis. Here's one-off expenses that are going to happen these years. It's not going to be every month, but here's how. Then the idea is to kind of make sure, run a stress test, run our financial retirement plan blueprint, make sure your picture supports that spending level, and then come up with a tax efficient way and earmark funds and liquidity for how to get that monthly paycheck. And then also when those big expenses come up, you've already ran the math and permission yourself to do it. So you have a game plan on how to fund those. So big fans of running a retirement trial run, stress test it, the Monte Carlos, kind of our stress test of choice. And that way you could design all this. I should note, I don't have a bullet on the slide. We have a really nice one-page front and back spending sheet that has kind of the main food groups of your spending. And so I'm real happy to provide that. I'll have my contact information at the end of the presentation, but yeah, you can just go to our website and contact us or email us at TEAM at Stabler, WM, like wealthmanagement.com. And we'd be happy to get that cash flow sheet over to you because that's a great tool as you're modeling out your expenses. And by the way, this is a good thing to do now, even if you're 5 years from retirement versus waiting. It just allows you to be really intentional and make sure your money's working hard for you in the right way. Okay, great. Okay, so with that, next slide, Social Security planning. Social Security, you can't start until age 62. So you might be like, why are we looking at this? The reason is it ties into your cash flow retirement income plan really strongly. And so the way it works is you could take Social Security as early as 62 or wait until 70. The earlier you take it, you get more payments, right? But the amounts are less. Every year you wait, it grows about 8%, plus there's a cost of living adjustment. And so essentially when you're 70, your Social Security benefit will be double or in that ballpark of what it is at 62, but you missed out on those 8 years. So that's a really important analysis to do. Before I kind of get into more thoughts on that, the reason I want to bring up Social Security in this presentation is that the same way that we know Medicare is going to be on the table at age 65, and we need a bridge towards that, it's the same thing with Social Security. This is an income source that you're going to have between age 62 and age 70. And so a lot of times in the early retirement years, we're bridging until when that Social Security clicks on. And so you may be taking out a higher withdrawal from your accounts as you have more health insurance expenses on premiums and you don't have Social Security yet. And that's commonly okay. We'll want to do the math and run that. But again, we know that this is going to flip on at some point, assuming it will be there. We've run a lot of analysis on this. We expect it to, but we could go over that more with you individually as well. But again, Yeah, so I wouldn't freak out so much if you're like, hey, I'm running the math. I Googled how much to withdraw. It says 4%. I have to take out 5% because, these additional expenses and I don't have Social Security. We want to look at the full body of work, right, to determine what the right withdrawal plan for you is. A little bit about Social Security. If you're married, you and your spouse are a team. A lot of times we'll have the lower Social Security benefit spouse start theirs earlier, possibly at 62, and then the higher earner will delay, possibly until 70, based on your situation and goals and feel towards Social Security. But one of the reasons for this is that when one spouse passes away, the deceased spouse loses a lower benefit but gets a higher one. And so even, let's say you have a higher Social Security benefit than your spouse, you delay, you grow yours a bit, your spouse takes theirs early. If you pass away before your spouse, they would flip to your higher benefit but lose theirs. And so again, it's good to look at a combination as a team. And so we definitely want to coordinate that in conjunction with your retirement plan. Okay, good, good, good. Okay, so I kind of left this towards, I know we're kind of on the latter part of the presentation. I mentioned you treating your RSUs as a cash bonus is one. This is probably the second thing to really, take note on and remember is how to manage your stock concentration risk. Just throwing it out there, like most Microsoft folks we meet, have a good chunk, probably more than half their investments commonly in Microsoft stock. And it's been an awesome ride, right? That's great. But it's kind of like going to the casino. You go on a nice little heater on the blackjack table. At some point, things are going to possibly likely turn in that example. And so it's good to just say, hey, I've won, I've done well. Now I'm going to take a step back and look at what's the right investment allocation for me and my situation, and how do I manage that? And so I know, top of mind is typically for folks I talk to, they're like, yeah, I know I have too much Microsoft stock, but I don't want to get hammered on taxes. Okay, so here's how we think about that. So rule of thumb, if you got more than 10% of your investment portfolio in one company, that's pretty concentrated, whether it's Microsoft or a different stock, that's the back of the napkin. Really the correct exercise to do is run a robust retirement plan stress test. And we like to shock the system. What happens if Microsoft or, just the tech industry or whatever it may be takes a big beating, a la 2000, .com bust. I know Microsoft's a very different company. I've been around a while with the profitability, but nonetheless, let's just say something happens where that stock or that area of the stock market, gets hammered, more than the rest of the stock market. We like to run a stress test and see how your portfolio can handle it. And then based on that, we could tell you, here's an amount that we're comfortable with. A lot of times it's more than 10%, but, we may collectively decide on a number, could be 10%, whatever it may be, that's a fit. But it's good to see when we stress test it, it won't derail your retirement. And so there's a lot of different strategies if you have too much concentration risk to reduce that down. First thing, back to my first point, sell your RSUs as a vest. They're cash bonuses. You're making it's the same concept of making the decision to buy the stock with a cash bonus by keeping your RSUs invested. So if you're already overly concentrated, that's an easy way to not continue to, add fuel to that fire. Other things, I commonly see folks have Microsoft in their 401ks. Depending on your level and situation at Microsoft, I know there's kind of nuances here, but in general, you could sell your Microsoft stock in your 401k with no taxes. That's a great way to do it. Other things, when we look at your stock awards, you have a zillion different lots based on all your time at Microsoft. Each one has a different cost basis. And so we commonly are able to sell a third of a client's Microsoft stock at a really reasonable tax rate by cherry picking which lots we're selling and selling the ones that proportionally have the highest basis first. So that's something we'd love to run the exercise with you and kind of go over our findings there. And then lastly, if you do 1, 2, 3, and you're like, I'm still got a lot of Microsoft stock, and it's beyond your comfort zone, we could do different option hedging to basically take out quadruple bogey, limit the downside risk to a certain level. And I really like these, because basically it may be a common one we'll do is over the next year, year and a half, we're limiting losses. If Microsoft's down more than 20%, we're limiting our max loss to 20%. And then what you can do is sell calls or upside that basically covers the cost of that downside insurance. And it still gives you a ton of upside on the stock while taking out, again, that real Armageddon scenario. So again, a lot of different ways to go about this without getting hammered by taxes. So really encourage you to talk to us about it. Um, okay. So when I think about over stock concentration risk, um, I'm actually, very bullish on Microsoft. I think Microsoft stock will do well, but the question is, would you bet your retirement on that? Would you bet the chance of having to go back to work on that? Because nobody's certain on anything, right? Especially in this changing landscape we've seen. And so the way to think about it is, here's a projection. Here's someone. Let's say they're in their early 50s. They got 2.5 million in their investments. That's the starting point. And the dark blue line is if they're just in like a good balanced retirement portfolio, you could see that their money in this situation grows even after their expenses and withdrawals. Their assets grow in more than, almost triple, right, in retirement. We have inflation, dollar, hamburger is going to cost a lot more in 20 years than it costs today. But nonetheless, I think like the holy grail of retirement is having your money grow a bit in retirement to keep up with inflation. The light blue line is if the market does really well, like my Microsoft stock does great, I could have $10 million when I'm 95 or whatever it may be. And then the orange line here shows the downside scenario. And what's nice is in this base diversified retirement portfolio for this client situation, even if we had crummy markets in the decades ahead, which is really possible. We've gone through a heater in the markets the last, 15 years. From any measure, the stock market's very expensive. I think there's a lot of things to be positive about, but I'm not talking to anybody who doesn't agree. There's a lot of concerns out there too, right? There's a lot going on in the world, plus an expensive market. And so what's neat is this downside scenario, that kind of middle orange line, not the lowest one, kind of a lighter orange line. Even when the downside scenario has this person's investments holding in retirement, right? So they're not losing money. When you have too much concentration or you're allocated improperly when you go into retirement and you're going to start taking money out, the upside is the stock could keep doing gangbusters and you could have way more money. Instead of 10 million, maybe you have 12 million when you're 95 or whatever it may be. The downside scenario is that a single stock, no matter how good of a stock, has multiple time of the stock market risk of a broader market. Not to mention a diversified portfolio of stock and bond. And so in that downside scenario, you could see the dark orange line at the bottom, a thicker one. You may be running out of money in 20 years, right? And if you're 55 and you're 75, who wants to be dusting off the resume at 75 and stressing out about that? And so I think what's good is we want to build a range of outcomes which gets the job done. It feels good. We have clients, some clients like to be more aggressive. That's totally fine, right? But doing so in a way that takes out that Armageddon scenario where you have too much concentration, just really, I do not stress out about a person's picture that's balanced where we've done all the work. If someone has not done the pre-retirement work or is invested incorrectly, I stress out about it, and so they definitely should. And so this just shows we want to control the range of outcomes. And that's how we think about over concentration. Okay. So as we kind of wrap this up, I always like case studies. It's nice to see, in an actual scenario, what's this look like? And so this is a real client scenario, change the picture, change the name sort of thing. But, okay. You're 55 years old. You're ready. You hit your 55 and 15. Your stock's going to keep vesting. And you're like, boom, I'm about to do this. So first off, in an ideal scenario, in those ramp up years, Treat your RSUs like cash bonuses. Use it to fund your mega backdoor Roth and your health savings account, regular backdoor Roth, maybe even ESPP, right? We'll kind of look at stock concentration planning. But basically, in the years up to 55, you've been pumping hundreds of thousands over multiple years into tax advantaged accounts or discounted accounts. So that sets you up for retirement with the ground running. 55 and 15, RSUs continue to invest. Let's say someone has 300,000, 400,000 of unvested stock awards over the next 4+ years. Those will continue to show. Treat them like cash bonuses. We sell them when they vest. That's a great starting point for retirement income. This person's on COBRA. So they're 55, them and their spouse get on COBRA. Yes, it costs more than the insurance now, but it's reasonable. And in those years, we basically max out the 24% favorable tax bracket through a combination of selling, taking capital gains to kind of build up money in the conservative war chest liquidity bucket in a non-retirement or trust account. And basically that allows, after COBRA's up, to use some of that money that's already been paid tax on to fund the withdrawals in those retirement years so we can manage the health insurance premiums being lower. And as noted in this case, they save $12,000 a year in health insurance premiums. Not too shabby. It's pretty nice over a decade. And then with all this, stress tests show over 90% success rate, which is great. That's a great in the green number. Some of you overachievers out there might be like, hey, I'm 100% test type of person. What's with the 90? When you're 55 and retiring, there's such a range of outcomes that could happen over the next 40 years, 40+ years potentially, that it's really hard to get 100% success rate. And so we think of this as what's a percent chance you don't need an adjustment. So if you score a 90, there's a 10% chance if we hit a massive depression or something like that, we may adjust spending habits or do different things, right? And so we have different levers to pull. So, being in the green, being at 90%, even high 80s is a great number. But we're doing all the work to make sure that you have a solid retirement plan before pulling the trigger. Good. So I hope that was great stuff. Couple things. We do a white paper every year, Microsoft Financial Planning Guide. This is an awesome cheat sheet. If you go to our website and on the top of the website under Who We Help, you can see that there's a Microsoft page. If you click on that, it gives you an option to get a copy of our white paper. Another option is you can just email us at team@stablerwm.com and we'll get you a copy. For joining, we're offering you a free second opinion on your retirement plan. No costs, no obligation. Basically what that'll look like is we'll kind of go over your financial picture, answer questions that you have, highlight things that jump out, and really provide you a lot of good feedback and kind of let you know directionally things that jump out if we're on the same page. Best way to do that is you go to our website, big orange button up at top right. It's called Let's Talk. If you click on that, you get in touch for us with the white paper, but also you could set up an appointment to meet with us, and we'll set up a time to review your retirement work optionality picture and weigh in. When you set up that time, you actually set up a meeting with me. We'll set up half an hour where I'll get to know you, go over your goals, your thinking. What will happen is we'll set up a session, we'll set up a deep dive. And then if you're saying, hey, this is helpful, this is great, we're interested in working with you, from there, we could set up another analysis session where we'll run a retirement picture, provide a full projection. And then if it looks like we might be able to help you as your financial planner and fit in, we could then set up those follow-up sessions where we'll peel back the layers of the onion and go a bit deeper on your picture. Okay. We're going to keep the webinars coming. We love to help people, and we have a lot of experience, of course, with the Microsoft plans. And so hope to talk with many of you. If not, keep an eye on other webinars and events that we're doing. And if there's any topics you have in mind that you think would be helpful too, give us a shout, and we'd love to work those in as well. Thank you again for joining. I really appreciate it. And we'll talk to you soon. Take care.